I'm going to tell you single most effective investment strategy available to a regular person with a regular income in a regular brokerage account. No options, no leverage, no crypto, no timing the market, no secret indicator, no premium Discord server required. Just one strategy proven over decades, accessible to anyone with $50 and a brokerage account. Mathematically superior to almost every alternative in financial industry has ever tried to sell you. And I'm going to warn you up front, it is so boring that your brain is going to resist it, because your brain was built for novelty and excitement and the dopamine hit of feeling like you figured something out. And this strategy offers none of that. It offers something better. It offers results. Welcome to the Top Finance. Today we talk about dollar cost averaging, the strategy so simple and so effective that the financial industry spends enormous energy trying to convince you it's not enough, because if you actually use it consistently you wouldn't need most of what they're selling. Let's start with the definition, because most of people have heard the term and approximately half of them could explain it correctly. Dollar cost averaging is a practice of investing a fixed dollar amount into specific asset at the regular intervals, regardless of what the price is doing, every 2 weeks, every month, wherever your schedule. Same amount, same asset, no matter what the market is doing that day, that week or that year. That's it, that's the whole strategy. When the market is up, your fixed amount buys fewer shares because each share costs more. When the market is down, your fixed amount buys more shares because each shares cost less. Over time, the average cost per share you've paid smooths out across markets highs and lows. You're not trying to buy at the bottom, you're not trying to avoid the top. You are simply accumulating shares consistently across every market condition that will ever exist. Bull markets, bear markets, crashes, corrections, recoveries, and letting time and compound growth do the rest. It sounds almost insultingly simple. That is not an accident. The best financial strategies are simple. The financial industry is complicated because complexity generates fees, simplicity generates wealth. Here's the psychological problem with dollar cost averaging. It is a genuine problem that causes real people to abandon the best strategy available to them. It feels wrong during a crash. When the market drops 20, 30, 40%, when your portfolio is visibly smaller than it was 6 months ago, every instinct you have screams to stop, to wait, to protect what's left, to sit in cash until things stabilize. That instinct is wrong. Mathematically, provably, historically wrong, and it costs the average investor approximately 1.5 to 2% in annual returns compared to investors who simply stayed the course. According to the research on investor behavior versus market returns going back decades, the investors who kept buying during the 2008 financial crisis, who dollar cost averages through the worst market collapse since the Great Depression, bought shares of S&P 500 at the prices that would never been seen again. By 2013, market had fully recovered. By 2020, it had tripled. Every share bought at the bottom of panic was bought at a price that looks like a gift in retrospect. The investors who stopped buying and moved to cash, who listened to their instincts, locked in their losses and missed the recovery. They paid the highest possible psychological tax on their portfolio. Fear sold low and missed buying lower. Dollar cost averaging works precisely because it removes the decision from the equation. You don't decide wherever to buy this month, the automatic transfer decides. Your feelings don't get a vote. Let's run 3 scenarios on the same person making the same income with 3 different approaches to investing. Same person, $500 to invest, 30-year horizon, S&P 500 index at the historical 10% average annual return. Scenario 1, the dollar cost averager. Invest 500 every single month for 30 years regardless of market conditions. Total invested $180,000. Final portfolio value approximately $1,130,000. Scenario 2, the market timer. Tries to buy dips and avoid peaks. Studies charts. Read forecasts. Gets it right maybe 40% of the time, which is actually substantially better than most professional fund managers. Missed an average of 2 market days per year by being in cash. Final portfolio approximately 650,000. Missing just 2 days per year. The best 2 days per year cost this investor nearly $500,000 over 30 years compared to someone who simply never tried to be clever. Scenario 3. The inconsistent investor. Invest when they feel good about the market, stops during downturns, restarts, stops again. Averages 8 months of investing per year. Final portfolio value approximately $750,000. Being inconsistent cost $380,000 compared to being boring and automatic. The dollar cost averager wins, not because they're smarter, but because they never stop. Here's the question that always comes up and deserves a direct answer. If you have a lump sum, an inheritance, a bonus, a settlement, is it better to invest it all at once or to dollar cost average it in over time? The honest mathematical answer is lump sum investing beats dollar cost averaging approximately 67% of the time over 12 months period, according to research by Vanguard and others. Because markets go up more often than they go down. Getting money invested sooner captures more of that upward movement on average. So mathematically, lump sum when you can. But here's the human reality that math ignores. Most people who receive a lump sum are not emotionally equipped to invest it all in a single day and then watch it drop 15% the following month without panic selling. The psychological cost of that scenario leads to exactly the kind of behavior, panic selling at the bottom, that destroys long-term returns. Dollar cost averaging a lump sum over 6 to 12 months produces slightly lower expected returns than immediate lump sum investing. It produces dramatically better actual returns than lump sum investing followed by panic selling during the inevitable correction. The best strategy is the one you can actually execute without your emotions destroying it. Here's the practical implementation the most finance content skips because it's not exciting enough to pad out a course model. Step 1. Open a brokerage account if you don't have one. Fidelity, Schwab or Vanguard for long-term investing. All three have no account minimums and no trading commissions on index funds. Step 2. Choose your fund. For most people in most situations, a total market invest fund or S&P 500 index fund with an expensive ratio below 0.1% is the correct answer. Fidelity's FZXROX has 0 expense ratio. Vanguard's VT-SAX is 0.04%. Schwab's SWTSX is 0.03%. They're not exciting, they are correct. Step 3. Set up automatic investment on your payday schedule. The moment your paycheck clears, before you see the money, before it becomes available for spending decision, it moves automatically into the fund. This is the most important step. Automation removes willpower from the equation entirely. Step 4. Do not look at it. Seriously, set your check-in schedule for quarterly at most. Daily portfolio checking is not monitoring. It's a manufactured anxiety that serves no financial purpose and significantly increases the likelihood of emotional decision making. Step 5. Increase the contribution amount every time your income increases. Every raise, every bonus, every windfall, a portion goes to increasing the automatic contribution before it gets absorbed into lifestyle. This is how the boring strategy becomes the life-changing strategy. Here's the uncomfortable truth that this entire video has been building toward. You already know what works. You've always known. Invest consistently, invest early, invest in low-cost index funds. Don't stop when it gets scary. Don't try to be clever. Automate everything and get out of your own way. You knew this. The reason you haven't fully done it is not ignorance, is that this strategy produced no dopamine, no story, no moment of genius when you call the bottom, no screenshots to post, no feeling of being smarter than a market. It produces something far less exciting and far more valuable. It produces 1.1 million from 180,000. The financial industry survives by making you feel this isn't enough, like you need more strategies, more products, more complexity, more premium access to think that will finally unlock the returns you deserve. You don't need more. You need automate $500 a month into total market index fund and then spend the next 30 years doing literally anything else with your time and energy. This This is the whole strategy. It is boring, it is proven, it is available for you today. This is Soft Finance. We don't make boring exciting, we make boring rich. Subscribe because the next video is going to give your brokerage app even more reason to feel unnecessary. And if you don't have an automatic investment setup right now, close this video, open your brokerage account, set it up, and then come back and watch the next one. We'll be there.